Greetings from the desk of Dr. Jeff Hong. Welcome back to the continuing lecture in corporate finance. Today's topic is cost of capital. Now, we already understand what cost of capital is from the previous topic, the previous lecture, which was capital budgeting. And if you remember, capital budgeting is a straightforward discounting process, right, to find the net present value. So it is inevitable in any discounting process, it's inevitable to use a discount rate. And the cost of capital is a generalized concept of the discount rate because discount rate would vary depending on what capital is used, right? So the cost of capital is a broadly defined as average rate paid for the use of the firm's capital funds. Of course, the capital we are talking about is the long-term capital, long-lived capital used, long-term capital used to acquire long-lived assets. And this cost of capital provides a benchmark against which to evaluate return on investment. Remember in the previous topic of capital budgeting, right? The decision criteria is either net present value being greater than 0 or positive, or internal rate of return being greater than cost of capital. Remember that? And at the time, we didn't really fully discuss how cost of capital is constructed. We just took it as given. But actually, the cost of capital is a weighted average of the return on the benchmark returns on each type of capital components. So projects should not be undertaken, right? Just like in internal rate of return, projects should not be undertaken unless the return on investment, right, is greater than cost of funds invested in them, right? So in other words, what are the funds invested? What type of funds? We already know, from the fundamental analysis, there are two types of capital, right? Either equity or debt, right? They are called also capital components or capital elements. But we need to look into the equity a little closer. We just call it equity, but there are two types of equity. Remember, there is common stock and preferred stock. So we split the equity into two types. So then the capital components employed will be classified into debt and preferred stock and common stock. Okay, and the cost of capital to each of these capital components would be called cost of debt, cost of preferred stock, and cost of equity, right? And equity here specifically meaning common stock, only common stock, okay? And the decision rule is, of course, is quite clear. If the project's internal rate of return is greater than the average cost of capital. In other words, we'll have to take the weighted average of all these different cost of different capital components. And if our internal rate of return is greater than K, cost of capital, weighted average cost of capital, then we accept. Or if the net present value is positive when discounted at our average cost of capital. Okay. And the capital components, we already talked about it: debt, common stock, and preferred stock. So then our capital structure, it's easy to calculate the capital structure. In our example, let's take a look at this example. This company has $30 million debt and $10 million in preferred stock and $60 million in equity. The total will come to $100 million. That's the total capital. And when we say capital, it's slightly different from total assets, right? Capital means always long-term capital. So technically, the debt here is only the long-term debt, not including the current liabilities, right? So if we include current liabilities in here, then this should be called total assets, not total capital. But when you say total capital, it specifically means, long-term capital. And if you look at the capital structure here, then of course, you divide, debt is 30%, right? Preferred stock, 10%, equity, common stock, 60%, right? So that's the capital structure. Now, the capital structure can mean just the current capital structure, right? Or the target capital structure. And in this topic, we will refer to the target capital structure, because no company just is just complacent with current capital structure unless the current capital structure is the optimal one. And remember, in the previous example, this company is pretty much, in this example is, where is this? This company is in pretty much near, I would say, optimal capital structure. I mean, if their capital structure is in general, by just the rule of thumb, their capital structure is relatively near optimal level. It would be quite, if the debt is 70% and the equity is 30%, then that would be not a very good capital structure. That would be, the company is leveraged too much, right? And too much leverage is not good, because increasing the financial distress, and it is prone to, it's more likely to go bankrupt. Okay. So target capital structure is optimal capital structure the company pursues. It's a mix of components that management considers optimal and strives to maintain. So, and they would try to raise fund in proportions of capital structure. When they raise new capital, they will try to maintain the current, the optimal capital structure, right? Or the target capital structure. and in proportion to that capital structure. So in cost of capital calculations, assume fund is raised in a constant proportion of debt, preferred, and common equity, according to the optimal capital structure. Usually either the current or target structure. Yes, but if the current structure is uh, completely off balance or completely off uh, the optimal structure, then they would uh, raise it in proportions uh, according to the proportions of target structure. Now, of course, it's somewhat unrealistic that it will be able to maintain that because why? Because the the current market value of these capital components would constantly change, right? Even it won't change drastically, but it will change even a little bit constantly because stock prices changes and your equity will reflect it. Your bond prices will uh, change, and the your valuation of debt will have to reflect that. And again, think about it. Um, like in the if the market situation is so volatile, like the recent um, month, the March, this March 2020, we saw like a drastic about 30% drop in the stock market, right? Across the board, most companies have suffered about 30% drop in their uh, stock valuations, their equity valuation. Then their market capitalization, that means their market capitalization uh, has suffered about 30%. And then how can the optimal capital structure be maintained? It's practically impossible, right? So that's somewhat unrealistic. So return on investment adjusted for taxes and administrative expenses, other forms of cost of capital. Uh, yes, of course, the return on investment is eventually, eventually it will have to be adjusted, right? The return is adjusted for because it's ultimately after taxes and after administrative expenses, right? The profit is always, the EAT is always the final result after adjusting for taxes and after paying taxes and administrative expenses, right? So the return on investment is the firm's cost of capital. Of course, these and the risk levels of these capital components vary. First of all, we all understand the equity, the common stock is the riskiest, right? They give you the highest return, therefore, the highest uh, cost, right? Cost of capital, highest cost of capital, right? In other words, you're discounting uh, the cash flow from the equity at the highest discount rate. Debt is the safest asset, so it gives you the lowest return. So cost of capital would be the least, and preferred stock is in somewhere in between. It has an intermediate risk between equity and debt. So the return uh, uh, levels and cost are between that of equity and debt. So you can uh, you can easily understand that the uh, cost of equity is the greatest, common stock, and then cost of preferred stock and cost of debt. Now, think about it. We are discounting the cash flows, free cash flows from the future free cash flows from the projects that the company is undertaking. So we must discount it. We must use some discount rate, but then which discount rate? Uh, that is that's the question. Uh, because the cash flow, future cash flow is generated as a result of the workings of these three types of capital components, right? So you cannot simply discount it by uh, cost of equity or cost of debt or cost of preferred stock because it's a uh, cash flow, future cash flow is the result of the combined efforts or combined workings of three types of capital. So um, then you might say, oh, then, why don't we use the average? Yes, we use the average, but you cannot, once again, it cannot be the simple average, right? Makes sense? It cannot be simple average. Why? Because because of the capital structure. If the capital structure is 30% debt, 10% preferred stock, and 60% common stock, and then uh, the cash flow generated from the project in the future, right? The future cash flow generated from the projects that the company is undertaking is the result of 30% uh, contribution from debt and 10% contribution from preferred stock and 60% contribution from common stock. That's why we have to take the weighted average, right? So, uh, so it's also called weighted average cost of capital, right? So here's an example. Calculate the weighted average cost of capital for Zodiac Company given the following information about this capital structure. And in Finance 100, we talked uh, extensively about the difference between simple average, weighted average, and geometric average. And here's so uh, you should know fairly well about the weighted average. But let's go. It's the example may not be really necessary, but let's go over this. So this is the capital structure of this company. Their debt is 60K preferred stock, 50K common stock, 90K. The total is 200K. And so out of this 200K, 9%, you divide this by this, 9%, divide this by this. Oh, I'm sorry, that's cost of K, right? Cost of capital, not the capital structure. Looking at the capital structure, you divide this by this, that's 30%. Divide this by this, 25%. Divide this by this, 45%. And the cost of capital for each capital component is like 9%, 11%, 14%. So weighted average cost of capital is simply weighted, right? Sum of all the weighted cost of capital. So this times this, 2.7%. This times this, 2.75%. This times this. 6.3%. You just sum it. That's 11.75, right? That's not that difficult, right? And especially if you put it into Excel, you can do it in a single shot. I mean, you would think this times this, right? You put that, you can build it there. In the cell is this times this, right? And you drag it down, and then sum it up. You get that. But also there is a nice function called sum product. Okay, we'll talk about that later when we actually do Excel, use Excel. Uh, when we do Excel exercise of this topic, okay. But if you use sum product, you get it's literally you're summing all the products, right? So it's done in a single shot. But anyway, and then next question is how do we um, what data do we use, right? How do we value our capital components, right? What data to use? Um, because our capital components can be expressed in either book value or market value. Well, let me get to the chase. We use market value of our capital components. Why? Well, which is the correct focus. Now, because we are evaluating the future cash flows from the future cash flows from the capital projects. So then it must be supported by capital raised next year. And book values, I've been telling you over and over, book values always reflect the past data. Book value is basically based on the past data because it's based on the capital that's been raised, right? So, and we are trying to evaluate the capital projects to be undertaken in the future, right? When we are doing the capital budgeting, remember, if we do capital budgeting, right? When we do capital budgeting, what is that about? It's about the project that is going to be undertaken, right? If we plan, we are budgeting for that, right? So the projects will be in place in the future, right? Generating cash inflows in the future. Of course, the investment goes in today if we decide on a capital project, right? So current market values represent our best estimate of the next year's capital market conditions. Okay, so market values are the appropriate basis for weighted average cost of capital for both capital structure and for capital cost, right? Cost of capital for each capital component. Now, so for structure, right, for capital structure, assume the firm will either maintain the present capital structure if it is their optimal structure, right, or near optimal based on the current market prices of its securities, or strive to achieve some target structure also based on current market prices. And weighted average cost of capital, use market-based component cost, right? So capital cost, right? Cost of equity, cost of preferred stock, cost of debt. So step one, develop a market-based capital structure, market value, right? Based capital structure. Step two, adjust returns. In other words, cost of capital, right? On underlying securities, right? Market returns on underlying securities. That means either common stock, preferred stock, or debt to reflect the cost of three capital components. Step three, combine the cost of capital components in calculating weighted average cost of capital. We've done this example, right? So here, let's take a look at this example. The Wachusett Corporation has the following capital situation. Debt. 2,000 bonds were issued 5 years ago at a coupon rate of 12%, right? They had, so they were paying, this bond was paying 12% interest a year. That was 5 years ago. They had 30-year terms and $1,000 face value. That means they have 25 years left, right? They are now selling to yield 10%. And what does this mean? Right? In Finance 100, I've made very, very strong, I stressed it very strongly that there are three ways. This means this is the discount rate. And there are three ways it is worded. Either the bond is priced to yield X%, or second wording is the comparable bonds are paying X%. Comparable bonds, right? Comparable bonds or similar bonds, they mean the bonds of the same risk class. Or third, although they don't say, the wording is never straightforward, like use this as a discount rate. They will never say that. So you should be able to catch the cue from those wordings, right? Sometimes they may say, the prevailing market rate is X%. But these are three ways, the discount rate is worded, right? They never say discount rate is X%. Okay? So anyway, that means we will need to use this as the discount rate when valuing the current market price of the bond. Of course, that's the rational price of the bond. Market price may be slightly off. I've been telling you, in the short run, there is always mispricing in the market in the short run, right? And it's because of that mispricing. You can make money from the market. If the market price is always exactly priced, if the asset is always exactly priced, then you cannot make money in the short run, right? The only way you can make money is, if there's no mispricing in the market, the only way is by, going long, right? In other words, holding for long term, right? And wait for the asset, wait for that asset to appreciate in value. or either going short, right? But there is mispricing in the short run, and that's why you can make money, right? Uh, so although we are uh, basically, if we calculate the bond price here, right, in this example, that bond price is rational price or intrinsic value, right? And we are assuming that the market is correctly pricing it, which is, of course, also an ideal situation, uh, because in reality, uh, market is either overpricing, overvaluing, or undervaluing in the short run, right? In other words, market uh, market is more likely to misprice the asset in the short run. Now, preferred stock, 4,000 shares are outstanding, each of which pays an annual dividend of 7.50. The original, so this is the dividend. Why did they give you the dividend? Of course, in uh, stock valuation model, stock valuation models are all basically called dividend discount model, right? Remember, because this the dividend. Uh, All valuation models are basically DCF, discounted cash flow model, right? But I've been telling you in finance, principles of finance, right? Um, Finance 100. Um, uh, we call it Finance 100, but you understand that's actually, not really that low level, right? Um, it's more like intermediate. It's not really intro. That's why I call it principles of finance, but it is not really intro. It's more like intermediate because uh, we have discussed and treated almost every topic on intermediate level. Now, in other schools, it's like 3,300 level, 3,000 level. Um, so bond valuation model is a typical example of discounted cash flow model. Uh, and this dividend discount model is a particular case of discounted cash flow model where that cash flow is specifically dividend, right? So dividend is quite relevant in valuing the preferred stock and common stock. But look, we need to prefer stock. In case of preferred stock, preferred stock is a perpetuity. Perpetuity means an annuity going forever, perpetual annuity, right? Perpetuity. So uh, it is in one of the dividend discount models is called constant dividend model or zero growth model because the dividend is not growing at all because it's perpetuity, and the perpetuity model is very simple, and because preferred stock is a perpetuity, we will need to use uh, zero growth model or constant dividend model to value it, right? And they originally sold to yield 15% of their $50 face value. So work out this number. Very quickly, you can tell 15% of $50 face value, which is their, uh, initial uh, selling price, right? 15% of $50 face value is 750, right? And the face value in stock is the opposite concept of face value in bond, because face value in bond is the maturity uh, value, right? The value at maturity. So it's called maturity value or par value or redemption value in case of bond. But in case of stock, it's the IPO price, initial, right? Uh, public offering price. Because stock has no maturity, no uh, end point in time. So there is no way to pinpoint uh, the terminal value, right, as the face value. And face value is the par value of uh, the stock in case of stock, and the par value, unlike the bond, par value is not the maturity value. Uh, the par value is the IPO, initial IPO price. So at the uh, time zero, the original right time, they sold to yield 15%, which is 750 of this face value, right? 15% of this face value. They're now selling to yield 13%. What does this mean? Once again, you must take the cue from this. This means if they are yielding currently 13%, what does that mean? This is the discount rate. Equity, what you said has 200 million shares of, 200,000 shares of common stock outstanding, currently selling at $15 per share. They already gave you the current market price, right? Whether this is the rational price, rational value, or intrinsic, it doesn't matter. Anyway, we are trying to find the market value, right, of the equity. So we'll simply take the current market price. Okay, so this saves us a little trouble because we don't have to really use discounted cash flow model or dividend discount model. Yeah, but uh, for target capital structure, uh, we will need to use the intrinsic value. But now it is using this. The market price, right? Develop what you says market-based capital structure. So first, capital structure, right? To find the capital structure, we'll have to find the market value of the debt. We know first, the bond, what you says bonds in the market must be determined. We know bonds have 25 years remaining. Now we talked about it. Pay interest of 12%, which is 12% of the face value or maturity value, which is or par value, which is 1,000, so $120 annually. And bond pays coupon or interest semi-annually, so $60 every 6 months. And the bonds are now yielding 10% annually, which means 5% semi-annually, right? Thus, each bond is selling for. So if you use present value of annuity, right? Present value of annuity for valuing the coupon payments, and simply the present value of that face value, right, 1,000, then we come to $1,182, right, which is the current intrinsic value or rational price of the bond. But once again, we are assuming the bond market is in equilibrium, so that the market price is equal to the intrinsic value, right? And we can tell this is a premium bond, right? Remember, this is a premium bond. In other words, it's selling above par value of 1,000. Why? Because it is paying you, look, 12%, which is better than the average market return of 10%, right? So the demand for this bond is very strong. So the price will have to, excuse me, the price will have to be higher than, excuse me again, price will have to be higher than the market, the par value. And they have 2,000 bonds outstanding. So the market value of the debt is then 1,182 per each bond times 2,000. So 2.365 million. That's the market value of their debt. Next is their preferred stock. And the preferred stock is a perpetuity, and the formula for perpetuity is dividend over R, dividend over K, right? That's the formula for constant dividend model or zero growth model. Okay, so if you do that, you come to this. Why? Think about it. What was the wording? It was originally selling for $50, $75, right? Was it? It was originally selling for $50, right? And and originally sold to yield 15%. So 15% of $50 is this, and this is fixed amount because they will pay you 15% of this par value. So this dividend doesn't change. That's why it's constant dividend model or zero growth model. Dividend is, and also that's why preferred stock is treated like somehow like halfway between bond and the stock because it pays constant dividend, like the coupon interest of the bond. So if it pays 750, which is 15% of $50, but if it is now 13%, it is currently yielding 13%. What does that mean? The selling price of the preferred stock must have changed, right, to yield 13%. In other words, if 750 is 13% of that X, what should be that X? Well, if you do that, right, in other words, if this is X times 13% must give you 750. So solving it backward, right? Solving it backwards, then you get 5769. And since there are 4,000 shares outstanding, right? You multiply that by 4,000, and you come to 230,670. And then the common stock is easy. Currently, market price is $15. So currently selling for $15 in the market. So multiplied by 200,000 shares outstanding, you come to 3 million. So then our value of the market value of the capital components, debt is 2.365 million, right? Preferred stock 230,670. Equity 3 million. So add them up. Sum of these 5.595 million. And the capital structure is this divided by this, 42%, this divided by this, 4.1%, this divided by this, 53. So look, this is almost like close to 60% equity, 40% debt capital structure, which is which could be close to optimal capital structure, or it could be slightly skewed more to uh, uh, out of the optimal capital structure, right? Slightly more skewed towards the debt. Uh, we don't know exactly what is the optimal capital structure of this firm. The optimal capital structure can be found by using calculus, but that is the topic in uh, our Finance 300 investment analysis. Okay. All righty. So then calculating the component cost of capital. Um, so we begin with the market return received by new investors in each capital components. So therefore, we have, cost of debt, cost of preferred stock, cost of equity. And then we need to make adjustment for tax effects and transaction costs to arrive at the cost to the issuing firm. So tax adjustment applies only to debt, right? Why? Because interest is tax deductible to the paying firm. What that means is, you remember, interest is paid before tax, right? EBIT comes before EBT, and after EBT comes the tax, right? So because interest is pre-tax, interest is a pre-tax item that must be subtracted before tax, right? Um, so you are, in other words, in paying taxes, you are benefiting as much as interest paid, right? Your taxable income goes down by as much as uh, interest payment, right? That's why they say interest is business expense, right? Interest is business expense. Therefore, business expense is tax deductible. So, cost of debt is then must be adjusted for tax rate. Okay, the Greek character tau, of course, stands for tax rate, corporate tax rate. So, cost of debt is, adjusted by as much as. So if the tax rate is 30%, and if your cost of debt is 10%, actually only, 10% times, 70%. So that would be 7%. Effectively, your cost of debt is not 10%, but 7%, right? Debt is made even cheaper by tax adjustment. And the uh, flotation costs are a percentage of a security's price. Why? When you sell new stocks, think about it, uh, preferred stock or common stock, you have to float it. Floating means, making an announcement on the print news media, right? Like print media specifically, because there has to be a paper trail, right? These days, it can be online, both online and offline media. They use both online and offline media. So there is not only paper trail, but also digital trail. Is making an announcement. And then you have to print new stocks, right? And then there is brokerage fee and things like that. That's all called, transaction cost or flotation cost, right? Floating an announcement, right? And floating, the new shares through the bridge, right? So you apply that to preferred and new sale of common stock. Um, and it increases effective cost, right? So actually, then you will need to adjust it by each capital cost. Um, Now, you adjust it by 1 minus flotation cost, and this will make effective uh, cost of equity and cost of preferred stock greater. Of course, think about it. You divide anything by 1 is itself, but you divide it by something less than 1, it makes it bigger, right? So that results in greater capital cost, right? So let's take a look at how we make adjustment for cost of debt. We already, it's just an example. We already discussed uh, the concept. Blackstone Inc. has or holds 12% coupon rate bonds outstanding. Oh, it shouldn't be hold. Uh, they, they owe this, right? Uh, so ignore this, right? Ignore holds. They have 12% coupon rate bonds outstanding. That means they owe, right? That yields 8%. Blackstone's marginal tax rate, including federal and state tax rate, is 37%. What is Blackstone's cost of debt? Uh, uh, they did it. It's a good. This example, they made it. In this example, they made it easier for you because usually, uh, because any business or any individual, if you have income from bond, or let's say, just to make it simple, when you pay taxes, right? Uh, Remember, in the second topic, right? Chapter 2, right? Which is, the financial statements and taxation. Remember, if the effective tax rate, right? We made adjustment for, if your uh, total effective tax rate is uh, like, you don't have to pay double tax in the state income tax, because you have already paid uh, state tax. You have already paid federal income tax. So as much as the federal income tax is subtracted from the state income tax, right? So it's like, remember, total effective tax rate is, federal uh, tax rate plus uh, state tax rate times 1 minus uh, federal tax rate. So that would, right? But if they wanted to make this example more uh, uh, difficult, or if they intended to make it give you a hard time, then they would make you find total effective tax rate. But they didn't do that. They just gave you the total effective rate already. So now, what is the Blackstone's effective cost of debt? So all you need to do is cost of debt originally is 8%, right? But after adjusting for tax rate, it is 5.04, right? Which is not that difficult, right? It's fairly easy to understand. Next, the cost of preferred stock. And you just make adjustment for, right? Just make adjustment for the flotation cost. So the preferred stocks of the Francis Corporation was issued several years ago, paying 6% of $100 par value. Flotation costs on new preferred stock are expected to average 11% of the funds raised, right? So funds raised is basically the par value, right? Part A, what is the cost of preferred if return on similar issues now 9%? So this is the prevailing rate, or this is the discount rate, right? The market prevailing rate for this class of preferred stock. In other words, if it is currently, it can be also the same question as, if currently the yield is 9%, what is the current market price? Okay, it was originally $100, and if it is, and 6% of $100 is $60, right? But if $60 is 9%, right? Then obviously the price is not $100 if $60 is 9%. We can backtrack this to find the current market price. Okay. Second, calculate the cost of preferred if the shares are selling at 75. Right? Actually, part A and B ask the same question with different given information. In A, the market return, okay, this is asking for, right? Asking for K, right? Adjusted K, right? Cost of preferred stock. And B is asking for the price. B is asking for K given the price information, right? So if currently it is yielding 9%, after adjusting for flotation cost, the adjusted cost of capital should be 10%, right? Now, in this part B, it's asking for cost of preferred stock, not adjusted, because we can adjust it later, but it's not what it is asking for. If the shares are currently selling for 75 cents, and if it is supposed to be 9%, right? If $6 is the dividend, right? And if it is giving you 9%, right? and if $75 is the result, in other words, the price it is selling for now after adjusting for flotation cost, right? What is the original? What is the original cost of preferred stock? And you get to that, right? You get to a 9% cost of capital, right? And then think about it. If you make adjustment for flotation cost, then it will still be 10.1%, right? If you didn't make it do this, then it would be automatically, 10.1%. Okay, then next is cost of common stock, right? But cost of common stock will take more time because there are three ways we can do this, and we already know capital asset pricing model. We talked about this in Principles of Finance. Is the basically number one. I mean that's the risk adjusted method. So using CAPM, CAPM is basically to get the that cost of capital, right? Cost of common stock, the discount, the required rate of return, right? Required return, which is cost of equity. The second method is using Gordon growth model or constant dividend growth model. Third one is risk premium. So we have to go through three methods. So it will take almost another hour. So we're going to back to this in the next lecture. So stay tuned for the next segment of video. And that's it for today. Thank you for watching. I'll see you in the next video. Goodbye.